Our sponsor for this show is Santangel's Roundtable Cap Intro Events, founded by my good friend Steve Friedman. What's a Santangel? It's actually a who. Luis de Santangel was the man who persuaded the Spanish monarchs Ferdinand and Isabella to finance the voyage of Christopher Columbus, one of the greatest investment decisions in history. Originally a newsletter that published profiles of small, undiscovered fund managers in incredible detail, Santangel's made a well-executed pivot in 2012 to the conference business, including its roundtable cap intro events. After 12 years and 23 events, the Santangel's Roundtable is expanding in 2024, adding a third event at Boston's Fenway Park to accompany its usual 2 roundtables held in New York. Like a traditional cap intro event, the Santangel's Roundtables are free for allocators to attend, include one-on-one meetings with managers, and offer opportunities to network among allocators and managers. It's no surprise then that the Roundtable attracts the most serious allocators in the world, including many of the top endowments, foundations, and family offices who rarely come together in one room. So I encourage you to visit Santangel's website, www.santangelsreview.com, to learn more and request an invitation. Welcome to the Compounders Podcast. On this show, we explore the topic of compounding from various angles, including through interviews with public and private company executives, investors who focus on compounders, and newer investment firms that are building a business they hope will become more valuable over time. All opinions expressed by your hosts and the podcast guests are solely their own opinions and do not reflect the opinion of SNN or its affiliates. This podcast is for informational purposes only. It is not investment advice and should not be relied upon for any investment decisions. We are not recommending the purchase or sale of any securities. The host and guests may be beneficial owners of the securities discussed. You should not assume that the securities discussed are or will be profitable. My guest on the show today is Maj Soueidan, the co-founder of Geoinvesting. Maj is a microcap expert who has been investing in the space for over 30 years. Maj and his team are always searching for potential multi-baggers as they perform extensive research on top-tier microcap companies. Given how out of favor microcaps are at the moment, I was curious to speak with Maj about why it has been so tough to be a microcap investor in recent years, what he looks for when he's assessing management teams, his approach to portfolio construction, especially given the illiquid nature of many microcap stocks, what most people misunderstand about microcaps, and the opportunities available in Canadian microcaps. Maj mentioned a number of securities on this podcast. I do not own any of them. And without any further ado, here's my conversation with Maj Soueidan of Geoinvesting. Maj, you've been a microcap investor for over 30 years. I'm curious about how the investment opportunity and maybe even the structure of the market has changed over that period of time.
Hey, Ben, thanks, man. Yeah, well, it's a lot been going on in 30 plus years. That's for sure. And I think that, I was just thinking about this actual question even before we this meeting today. And this, for me, it's changed a lot. And I've been through a lot. And I guess the really biggest structural change I saw, experienced myself at least, because if you look at me, I was investing in, the small cap world, really probably beginning in the mid 80s, in the later 80s, and in the early 90s when I really started really going with a full-time journey. And in there was a time where you would have the way it would work, and if you're an older time investor, you know that you remember this. It would be like, okay, the retail investor would find these smaller companies first. The institutions couldn't invest in them. You had this really nice kind of uptick in volume, and some of these great stocks, they would go up eventually, and then they would get to a situation where they're big enough for the institutional clients to come in and buy them. They would come in. And you had this really nice kind of pattern of how it would work, and it was a very broad kind of appetite for these nano cap and microcap companies. Enough appetite for it. It was a great time to really to start my journey at that time, because it was really good. It was a broad liking for the space. There wasn't the regular, I don't think there was, at least I didn't see as much of the anti-nano cap kind of sentiment that you see today. And there's some of the restrictions that are put on them by brokerage firms now, and even institutional investors don't even really touch the space. So then you move along a little bit, and then you have 2008 come along a little bit, right? And that just was, if you were, and I was, crazy invested in the space and a lot of illiquid companies. And if you went through that experience, you survived it, you came out of it, but you're a little scared for a while, and very tepid to get back into it in an aggressive manner. A lot of retail investors got blown out and never came back, or took for a long time to come back. And of course, institutional investors just said, you know what, we're done with this. We're not going to touch this stuff. And there were more restrictions there. And then, of course, brokerage firms put more restrictions on. I remember during that time, I mean, I had never experienced, I mean, I went through the dot-com crash. That was like a slow bleed, almost like 2022. But the '08 was just pure panic, over 3-4 days. I went into the recession, September of '08, feeling pretty good about myself. I was still up like 25%. And so I was still doing better than I think the market and a lot of other investors I was talking to. And then all of a sudden, boom, you're down like 50% in 4 days. But it was crazy. And I was actually experienced firsthand what trying to sell stocks into a pure panic mode market was like. And I would just look at a stock, I'd sell 1,000 shares of a 10,000 share position, and all of a sudden the bid just dropped, just drops by 15%, like that. And it was just amazing. There were some things I had to get out of because I was on margin. So I can imagine, you take everyone going through that in our space probably. It's a pretty traumatic experience. So I think that really carved out or eliminated a lot of people that were used to investing in these stocks. They didn't come back. But then you had really interesting, I think, dynamic there was that you would think that, okay, we come out of the recession with this more like this risk off mentality. Sometimes I'm getting overcold. And so you figured, okay, well, where's the flow of money going to go? Well, now, rates are coming down now. So rates coming down is more of a risk on mentality, right? So you have this weird dynamic in terms of afraid to be in the market maybe, but you have this risk on appetite with low rates. So, and this is my own observation, and I think that because of that, you had this mentality of I don't want to be in the market long term anymore. A lot of investors kind of got this mentality of we don't want to be long term investors anymore, and we don't want that kind of risk. So, and if you look at the actual average holding period of a stock, it's gone from 6 years to 6 months, and maybe even less now. But that was a study that was I looked at it maybe in 2000, maybe 13 or 14, I think. So I don't know what it is now. So that just tells you a little about where people's heads were at. So what do you look for in that case? You look for just the more speculative stuff that you think can go up real fast, biotechs, pump and dumps. And then, as you know, the low rates kind of inspired this really bull market in big caps and growth, where you could just borrow and raise money at will, and there was appetite for it. So that really kind of left this pocket of, where all the nano caps were, that I would like this GARP-ish nano cap, boring nano cap kind of stocks, kind of like not in demand when you look at everything. When you look at that part of the life of the investor horizon, the regulatory tailwinds against MicroCaps, and then just losing a lot of people, that takes time to rebuild. And so I think that was for me. So my first 20 years or 20 plus years of investing up until 2000, when you take out '08, but let's just say, let's go to 2022, or before to 2008, was very broad. I could invest in a broad, well diversified MicroCap universe. I had 400 stocks at one point at my peak, coming off Peter Lynch's, one up Wall Street. He would have thousands. So but I didn't live with that for many, many years, but there was a point where I really had a lot of stocks, and I was doubling my money every year for, you do the math, for 20 some years, with a very diversified approach using this GARP-ish kind of mentality. That changed in '08. I had to go more of a concentrated type of approach because the broad wasn't working as much, which was new to me. I didn't love to be a concentrated investor. But it taught me to actually, okay, well, I have to understand these companies a little bit more now because I'm going to be holding them long term. So that was a good evolution in my journey. And then 22 comes along, and now we're back to this, rates are higher. And you're seeing this immense kind of return back to that type of investing that was really well for me in that first 20 plus years. Now it's you have to you look there's more of this quality driven type of mentality. I think of course the speculative fire is still there and there's still pump and dumps and people want that stuff, but you're seeing a lot more of the money now come into the quality companies in this garbage world. And it's really working well in a broad mix. It's amazing, actually, that you don't see it in the Russell or the other indexes. So I think I think the evolution is kind of went from broad kind of portfolio of these nano cap stocks was working the first 20 years. When we went into more of a concentrated kind of, you had to pick your battles, period after '08. And now 2022 and on, we're back to this a little more normalcy, I think, where the quality matters again, making money matters again. These companies can't raise money at will anymore, so the money, you're going to invest in more those that can self-fund. And you're starting to see the slow bleed of really crappy companies slowly go to zero. You can and hopefully that I'm not wishing anything bad on anybody if you own these companies, but I think that leaves more capital for, the better companies. There's only so much capital to go around. And that's what I'm experiencing right now and seeing, and it's pretty beautiful.
So given that backdrop and the way the market has changed and like kind of where you could apply or like the way you could employ your strategy, I mean, what does the current setup look like? I mean, is like the return to stock picking as opposed to just pure speculative low rate environment? Does that in your mind set yourself and your strategy up for higher returns because people are going to actually appreciate quality versus just whatever growth at all costs kind of situations?
Yeah, exactly. And I think that how my strategy is going to go back away from this concentrated approach I've been playing it for the last several years, back to a very broad type of strategy. And so my portfolio isn't quite there yet because I'm still stuck in a lot of these names I have a high conviction in. I put a lot of money in them, and as I unwind those positions over time, I'm going to start back to employing this very very diversified approach across a lot of stocks. I don't know where it's going to cap out in terms of my diversity. Is it going to be 30? Is it going to be 100? I've been running one of my companies, MS MicroCaps. I haven't really formally launched it in a broad way, but we have it out there now. I've been testing an index there for the last 2 years or so, where it has about 80 stocks in it now. And in February of 22, I think we launched it, and it's just blowing the averages away. And all it is these smaller cap companies, garbage, going through accelerated earnings per share growth periods that are undervalued based on some metrics that I'm using. And the cool thing about diversified approach, Ben, is that it allows me to add stocks I probably wouldn't normally buy. Like I don't buy areas I don't understand too well or that I have less control on, with oil and gas, for example, or even the services, oil and gas services, or mining stocks. I normally wouldn't buy those, banking. But now I can do that in this thing. I can say, okay, there's an interesting company here. I can add it to this portfolio because if it goes south, it's not going to hurt me. But what I'm trying to see is some of those stocks are doing really, really well. And it's giving me a little more alpha here too, to having that, maybe some of those dynamics in there. And it's giving me a broad diversification across industries. And one thing we got to realize in the MicroCap world, Ben, is that like they're so uncorrelated in the market. They're uncorrelated themselves. They don't even correlate to the news sometimes that's coming out in the fundamentals, that sometimes you don't know when these stocks are going to move. And sometimes the one you expect to do well is the one that doesn't do well, in your timeline you got defined, and someone else does. So it allows that kind of to work out too. And when you look at Jim O'Shaughnessy's study from his book, Books from Wall Street, and it's a long-term study where the smaller decile of the market outpaces the largest decile by about 8.24% a year, 8.24%, I think it was. just by being there, you get that advantage. And that's how diversified can you get from that kind of study. So it shows you can do that. So if it ain't break, don't fix it. Now, what if you can go in there and take some of the better stocks out of that area and start maybe creating what we call a tier one universe. So we have a tier one universe that we kind of pick from to do this. And that's where my portfolio is going to start going to here slowly. And I'm really excited about it. I think what might happen too is once I've got this universe kind of cooking, that I might start developing mini portfolios from it. So maybe I'll take 5 stocks and put them in maybe a little heavier weighted position on the side somewhere or something. And I'm going to hold them for, forever. This index I've created right now is really so far was created mainly to kind of with an 18-month, a 2-year time frame. These are companies that are going through that kind of growth phase. It might be interesting to start looking closer at that portfolio, the index, and say, okay, well, here's 5 or 6. I think it can go like maybe 10, 20 years. I think I have a really good runway. And then another mini portfolio that I'll be developing from it for myself and for our members and stuff is this buy and pullback contrarian portfolio where we buy stocks in the index that are falling for maybe temporary reasons or whatever it might be, or no reason at all, and start really playing in that. So I love that one because basically MicroCaps already hated space. So that basically doubles the bet in the hate, right? So you have these stocks going down for no reason. So you can get those. So I've had I think with Geo, for example, we made about 10 of those portfolios over the founding of Geo in 07, launching our first idea in 09. And the performance was freaking amazing on them. All of them were up at one point. All 10 of 9 of the 10 closed in positive territory. And we have our 11th one right now, I think, which we launched in September, which is up about maybe 27% or something right now, or 25%, over 7 stocks. It's a very concentrated portfolio, 5 to 7 stocks of these hated companies. And then we can have maybe 5 stocks of our favorite companies, then the index working across the whole kind of universe. That's how I envision it maybe happening over time. And I think as this plays out, we'll see how it works out.
I think when you say the words equality and GARP and tier one and microcap, a lot of people who don't focus on the space sort of chuckle and say, well, what could that even mean? Like how could there be good companies in this space? Haven't the private equity guys already bought them? Aren't the good companies staying private? What do you think people misunderstand about the quality and growth
Sure.
that you can get in microcap?
It's a great question, man, because I love that kind of pushback by people when they bring it up. But I'll say this too, that the index looks at what we define as equality based on a 10-point checklist we have, but we also look at high probability turnarounds also. So they might not be the more quality turnaround, but they might not be high quality yet. So we're looking for companies that are getting to that quality area. But to your question, I would counter it like this. I mean, what if I told you that some microcaps and nanocaps have hundreds of millions of dollars of revenue, or even $1 billion in revenue or more? There's this feeling that the microcap, the market cap of a company equates to what the revenue should be. And that's not right. If you look at BXC, Blue Links Holdings, it's a $1 billion company that was going through a bankruptcy basically, and a few years ago, in 2016, 17, it was not going through it; it was trying to avoid it. And that was why it was trading as a microcap, because there was uncertainty about the turnaround. It was still a real company, and it was a quality company, a quality business. And the stock now is like $120. It was $8 then, so I counter by saying there is a lot of bad stuff in the nanocap world. You're never going to avoid it. If you're looking at a good quality company, you can have a bad quality management team, or a management team that's not out there for your shareholder interests. So you have to be careful, no doubt about it. And that's another reason why diversification kind of helps in that space, I think. So if you have diversified equally positions in these stocks, you're not going to get blown out by some of the stereotypes that may be true from time to time in the space. But I think that there's a crazy amount of quality in the space. There's a crazy amount of companies generating a lot of revenue. Actually, if I pull up a stat here, this is a really interesting stat that we just pulled up on the index. to give you an idea of the quality that can be in this space. And let me see if I can find it here. 1 second. Yeah, I'll have to get back to you. It's basically, I have a stat here that basically talks about the revenue of the revenue and the PE ratio, the valuation of the index. And then here, I found it right here. So if we look at there's 80 stocks in the index right now, for example. 20% of it, by the way, is Canada and 80% US. But if you look at the total income generated from all stocks in the index, the last 12 months was 581 million. So that's real money, real profitability, real value being added to the to the US. I mean to the economy. So they are real companies, and if you can get over that one little stereotype that these are not all MicroCaps, you can actually you're going to find some really wonderful companies here, and you could live as an investor. You could live in that big cap, MicroCap, that's what we call it, space. MicroCaps with real revenue. You can live it all day long, never have to leave it, and do really, really well for the rest of your life. So, don't believe those misconceptions.
So I was listening to an interview with Ian Castle just this morning, where he was on the Investors podcast talking about 85% of the universe was I think his arbitrary number of like things that are basically uninvestable. Focus on that 15% that is investable. I'd love to hear your 10 given what elements of the checklist you'd be willing to share about like how you sift that through to find that 15% that's actually investable. Like what are the attributes of those companies?
Yeah, that's a good question too, man. So and let me give you a nutshell too. What we try and do here is we use that tier 1 checklist, which is 10 right now, marry it with a checklist of maybe at this point 8 multi-bagger or 9 multi-bagger markers. And then we try that's what we define the most timely investable companies for us. So that's what we're doing there. And those are multi-bagger markers that I've just written down over the last 30 years or so that just, I think, keep popping up over and over again. And when you marry it with the tier 1 space, and I'll be clear too, so that the tier 1 space is, we're willing to look at stocks, are they're going to get there maybe too, not maybe there yet. So I'll go down some of the list with you. So that when the first one, it might be, the two most important to me are the company. I like to look at companies that have been around for a long time. You have these old school management teams that still have these maybe old school maximization shareholder value kind of principles. They've proven they can go through lots of different environments and survive. Maybe they're not growing yet, but they're still around. They have a business, they have revenue, they have customers, they obviously have a product that's lasting. So, and I try and then go diagonal down to the 10th one, which is our capital structure. We want stocks with low outstanding share counts and no doubt and can grow organically. So we look at stocks that don't have a lot of outstanding shares. So those those that can grow organically without having to raise too much money. So those are really I think the two really most important things for us. And then if we can find those kind of companies, all right, let's go look at the other 8 characteristics or 7 that we like around that to see where a company is in that. So do they have revenue? Simple, right? Are they profitable or at near profitability? That's obvious, right? Is there insider ownership? These aren't secrets, right? Everyone does these, right? Does it have a manageable debt burden? That's important to us. We will look at high quality turnarounds and a management team that's more focused on the business than pumping the stock. So I'd rather you spend, instead of paying $20,000 a month on IR, spend $20,000 a month on someone quality and bring somebody in and maybe sell the product or put a service. And I understand the need for, but if you're selfish, sometimes you want stocks to go up faster, and then of course faster is better. You make more, it's high value money. selfishly, yeah, do I want companies to go out there and tell their story? Sure. But I don't think they have to. I mean, you look at some of the best companies, RWWI around worldwide, one of the better multi-baggers in the space. That's gone from, a couple dollars to right now, I think it's up $17, and it was as high as 25 not too long ago. In a span of maybe less than 10 years. They don't put out anything. And they're an OTC company doing like 70 million in revenue, or maybe more now, a quarter in revenue, pays a dividend and special dividends, hasn't raised much money in the whole time frame, has done no IR and no IR. And that's beautiful. So so that's really important. So you come with these companies that are just so focused on stock price. What happens in that with some of those teams is that they end up doing things maybe that aren't the best for shareholders in the company, but might be good for the short term, but not great. You want the company to think about the long-term vision of the company. That's how you want management to think. So those are basically the nuts and bolts. So I'm looking at companies that maybe aren't quite there yet, that are moving in that direction, because then I can get a better entry point sometimes before the market finds it. But obviously, if you find a company that meets all those requirements, is going through multi-bagger kind of markers, and still hasn't been discovered by the market, that's the best one. You found this company that's already packaged beautifully. If you take like, by the way, I do own RWI still, RWWI. I don't own BXC. I think we talked about that earlier. And I don't what was the other stock we talked about? I don't know. I'm not gonna say I'll go back and think about it later. But so just for disclosure purposes. And if you look at these, this checklist, and I know some people are like, checklist, it works. It doesn't have to be hard. Peter Lynch used them. He was all about, using Cliff Notes. I think Buffett, these guys, they all believe checklists are useful. And it's just, you're going to fly a plane, pilots there with a checklist. No different than investing. Why would you enter your portfolio without a checklist? At least knowing what you got and knowing what you don't have yet. It helps you understand the story, the risk, the weighting of the weighting of the stock maybe in the portfolio.
In the other pushback that I get on MicroCap is the same things like, okay, you found something, congratulations, it doesn't trade. And let's say even if it does go well, why would the stock ever go up? With the number of investors in this space, as you've talked about, has dwindled starting with 2009, and it's probably accelerated since then. So how do you think about that element of like, okay, you found something that fits all of those criteria or a lot of those criteria, like isn't there a big risk that it just lives in obscurity for a long time? How do you get past that?
Yeah, that's a good question, man. Like I've owned stocks that are so liquid, and those are liquid, and we did a volume study in our index, and it hasn't been a problem, by the way. So, but my answer to you would be this: it would be that value matters at some point. It might, if it's a crazy illiquid company, it might matter at a later point in time than it would for a more illiquid company. But I'm just a true believer of if you the risk you run in that situation is that you hold it. You found a great company is undervalued, illiquid, and maybe now you've held it so long, and now it's entering into trouble spots. So nobody recognized it during the great time, and now there's a good point, right? So that's why I think when you're investing in these illiquid companies, it's really more important to understand the long-term vision of the company, because you might be holding a long term. But I've always found that, man, at some point liquidity happens. It comes, and it's either going to happen because the stock just got too undervalued that you're going to have people like me out there who's just going to find and buy it. And you have these pockets of liquidity. When some of these stocks, there's always people want to get out of these stocks at some price, and you find liquidity. But yeah, I think that it is an issue. It's something you got to think about for sure. But mainly on the exit. If you got to hit the exit button, how do you do it if you're wrong on your investment? Because that's harder to do, to get out of these liquid investments. Position sizing also. That's why if you have these smaller positions in a very diversified portfolio, you can have exposure to these liquid companies and not have it matter. And as these stocks go up, and if you're right, and they start going up in price slowly, whatever, they become more liquid because you're just going to start attracting more people. So I haven't found it to be a big issue yet, to tell you the truth. I love that. The more liquid, the more I love it.
And given your strategy and, given the nature of these companies, and some of them are turnarounds, and there's other ones where obviously there's some structural or secular growth. I mean, I think you'd also want to layer on some kind of catalyst if possible. How prevalent is that, like searching for catalysts within your process?
I think, for as a full-time investor, it's important for me because, um, if I'm going to depend on my investing income to live, I need to understand I'm going to have some income coming in at some point. So I try and catalysts. I know some people look at catalyst as catalyst overused word, but I think I love it. I think there's just event-driven catalysts work. Whether it's a sale of an asset, restructuring a balance sheet, whether it's an earnings period that's going to go, be explosive for a few quarters, that's a catalyst too. So I am clearly looking for these companies that have these multi-bagger markers, whether it's, and that will include some catalysts that are hitting those things. I don't want to be like, I know there's this thing like some people don't want to wait. You buy a profitable company that's cheap enough and you just wait. There is that mentality, right? There's 10,000 stocks in this smaller MicroCap world. There's enough companies going through changes right now that are undervalued that people haven't found yet that I can buy them. And I said, my boring catalyst is really, it's always, to me, it's in the end, it's about the earnings. Can I find these stocks that are going to enter a extended period of maybe at least 4 to 8 quarter period of new growth cycle and earnings that are undervalued? That's as simple and boring as it gets from me. Now that catalyst could be, hey, selling an asset to pay down some debt. That could be part of the catalyst that kind of does that, right? I think I found that when you're dealing in that world, they're all restructuring at some point.
Yeah.
They're all going through a turnaround. You learn that very easily, very quickly, that they're all doing something to turn around the company, right? Nothing is perfect.
I think
But yeah,
people.
I believe it's really a really big part of the. There's so many ways to make money, short term and long term, but you can make so much money short term to supplement your long term portfolio by really honing in on like catalyst type of investing.
And I think people would be curious to know like how small companies you actually invest in. Like, so give me a sense of like maybe in the index or in your portfolio, what does average market cap look like? And then how far are you willing to go down?
Yeah, I think, yeah, I mean, the most of my companies are going to be well south of 50 million that I own personally. So but the index is but I'll go as high as 500 million. I'll even go as high as a billion or two on some of them, if I really like the company. Might not be a nano cap anymore, but I will get exposure to the small and mids once in a while if I see an interesting opportunity. Yeah, but I don't know if we have that stat here. Let me see. Maybe he might have carved it out. Let me see what we got here. This is interesting. He has the volume analysis. He does have this over here. Yeah, but which confirms there's enough volume in their index to manage like a significant a significant size portfolio. I think we said maybe $10 or $20 million portfolio.
Interesting.
That we did this, but I don't have the average market cap in here. But I will tell you that my smallest one is. Just take a look at something right now, real quick, to give you an idea of how small I get here. That's 28 million. Okay, here's one for 8 million.
Wow.
10 million. Small enough. Let's see here. There's some small stuff here. Here's one, 7 million. Yeah, so I wouldn't say that's the average, but that's I just 3 million. That might be my smallest right now. I just started buying today actually. But I also own some that are much higher than that. I have some here that are, for example, what we got here, what, 360 million.
Yeah.
Yeah.
So that brings up an interesting question, and it's something that I've thought a lot about in the microcap space is like, there seem to be these different tiers, and maybe there are these artificial labels like nano cap or micro cap or whatever. Like what that means exactly depends on the person. But I'm interested more like how big a difference in terms of quality is a 360 million revenue, sorry, market cap company versus a 3 million. I mean, is it like I'm just trying to like how big a gap is there in terms of quality? Because I could see someone saying, yeah, okay, fine. Like I get like maybe how a 300 million market cap company could make sense in a portfolio, but how could anyone say with a straight face that the 3 million market cap company has any quality aspects? So maybe talk about like the different tiers of quality and if there's any correlation between that and kind of market cap.
Yeah, let me put it this way, Ben. Let's take away the market cap for a second. Let's look at revenue. I mean, a $10 million revenue generating company with a small market cap might be a higher quality company than a higher market cap company with 300 million revenue. That one might be bloated with debt, and some other issues, competitive issues. They've been around for a long time. So really, that's how you kind of got to look at it. I don't think it's I don't think really I could say that there's this tiered approach to looking at quality. It's a case by case basis, but I wouldn't say that the larger cap company in the nano cap and small cap, layer cap sphere is always going to be better quality than a nano cap company. And it just might be that you have this high quality nano cap company that hasn't reached its growth inflection point yet. It might have a clean balance sheet. It might have revenue just sitting at a very slow growth pace. Might have a great CEO and good customers. Just doesn't have the growth catalyst yet. So that's how I would look at that. I would say there's a lot of these companies you see in the higher market cap arena are running into issues. They've been around for so long, now they're running into new issues. Now you have your issues as a small company, you grow. Now you got new issues as a bigger company.
Yeah.
So it's always like a changing kind of evolving kind of quality spectrum what you're dealing with.
And, I think when you're thinking about sub 50 million market cap companies, there's just not a lot of competition in the professional investing world. Obviously, there's retail investors, but people who have the experience that you have, and not a lot of the institutional what quality investors, quote unquote, focus there because it's just too small. And
Right.
so I'm trying to get a sense of like the level of competition you see yourself facing and how that's, your perception of how that's changed over time. Does it feel as if there are just fewer and fewer people looking at this? Maybe somewhat due to the fact that the brokerage firms have basically dissuaded people from even thinking about owning these companies.
Yeah, I think I don't have don't have stats on it, but you just know that it's definitely a smaller space than it was from years and years ago in terms of the people looking at it. I mean, there's just a lot more competition. There's ETFs now. You just have a lot more competition where to put the money. And when you have the videos of the world doing well, and you have the Apples of the world doing well, and the index is doing well, I think the mindset is why do I got to take that risk investing in stock picking and nano caps when I can get it over here. But I think that some of the dynamics we talked about '08 kind of hurt the market a little bit. But I do think that I think the interest is coming back a little bit. I think when you had the 2020 crisis, the COVID crisis, you had 10 million new investors coming to the market. So, retail investors. And there's going to be some stock pickers in there. So I think the stock picking market is coming back somewhat.
Yep.
And it might be getting more people involved. And I think the thing is the quality of the competition. How's that look? And I think you'll be surprised that there's some great, it's incredibly smart investors in nano cap world. I mean, it blows my mind sometimes. And so I think the assumption that there aren't smart people playing in the space would be a wrong assumption. So but there might be less of it. I don't know if that's true or not. I mean, I don't know if you have to be a smarter investor to be in nano cap world because you have all these extra risks you got to deal with. But I think that It's really more of a situation where there's less people playing in it. So if you're kind of got some savviness, you can have some really good fun time finding great companies, in the nano-cap world. And I do think though you have on the other spectrum, of course, you do have, I think, a lower quality investor also playing in the space that is allured by the pump and dump biotech mentality, speculative mentality, but they're not really. I don't think they're really looking at the because we will buy anyway. So, so I don't. I see most of the edge. The biggest edge in nano-cap world is the information disconnects because you have less people looking in the space. There's a better opportunity to find information before someone else does. It's that simple, man. Can you find information before someone? Because it all starts with the information, and it's really hard to like get an edge when everyone is looking at the same information at the same time. And you just have to dig deeper into some of these filings, conference call transcripts, to find some of the information you might want.
Yeah.
And it is and always will be, I think, the biggest edge you have in the smaller cap world. It's just getting actually. I mean, I know this just one stock was it CSPI. I don't know if you saw that one just took off from what $20 to $50 here in a few days, and that was basically he said stuff on the conference call, the CEO, that NVIDIA, AI, raising. I wish I could raise a dividend, but I can't. I can't right now. If I could, I think if I could buy stock, I would. All these things going on in a transcript, right? that aren't anywhere else in the press release. You probably wouldn't even hear a big cap guy do that anyway. And so the stock slowly that information slowly came out.
Yeah.
And that's what helped the stock. There was this other case, Ben, where, and I don't own CSPI anymore. I did trade it for a nice chunk. Now that there was a stock I used to own, ESCC, Evans and Sutherland. I bring it up a lot. They make equipment for planetariums, and also entertainment content for them. A really small market.
Yeah.
Tiny,
Totally.
like maybe $100 million. It was tiny, but they were like always owned about anywhere from 30 to 70% of the market share at any point in time. But they were going through a situation where I think it was 2014, where they had a pension liability, which was threatening the survival of the company. It was an unfunded pension liability. But they would be talking about in their press release how they're working at solving it. And the press release we're always a little vague in what's going on. If you took out all the costs from the pension liability and everything, they had charges, you got a pretty profitable company. Stock was selling about 20 cents, whatever. I think if you took away everything, you would see the tangible book value was maybe 80 cents or something. So there was a filing came out, and it basically said it was a 10K file or 10 maybe a quarterly filing. Somewhere in there, the subsequent events section, it said, "Hey, on this date, we are solving our problem, and we are selling. ERISA is taking this obligation off of our books. ERISA is the regulatory agency for that, and we're also giving them some stock too as part of the settlement." So that hits, and it takes time for that to come out. The stock eventually goes to $1.25 pretty quickly after in a short order, but you had time to buy it. So that was only in the filing. You're not a genius, right? It's almost like if you're talking to like a big cap guy or no, I can't do that's just too easy, right? That's not investing. Well, it is investing, and if I'm a beginner investor or intermediate investor. I'm just taking advantage of all day long. That's what I'd be doing all day long. Looking at the filings, looking at the conference call transcripts, looking at the press releases and seeing what information is in the transcripts and the filings that's not in the press release. Simple. And you're going to find some amazing stuff. And that is the edge. Really, that is the edge you have all day long. And you can go to these conference calls, Ben, ask questions. No one's on it but you.
Yeah.
But it's going to get you the right answer. And now it's on paper, right? That's there. So it can be referenced. And it's going to eventually, people are going to find it. That's an advantage. You control the narrative of these conference calls, and you can get information out there on the books. So
I love that. I really do. So we've talked a little bit about management, but in my experience, management always matters in investing, but it matters an incredible amount with small companies. So what are some of the characteristics you look for in management teams you want to partner with?
yeah, it's a good question, man. And well, of course, I think we touched on it before. That's one of the first criteria in my top 10 list is I prefer to have a team that's been around there for a while, that's gone through it. It's, see, I have this kind of mental checklist. Okay, have they been successful in the past? Okay, check mark. Has this management team actually worked together in the past at other companies? I like that when I come across that. Those are really two important check marks. What I really want to understand is what mistakes have they made
Mm,
and how have they faced those mistakes and challenges. One of my favorite questions to ask a CEO or CFO on the first call, and understand the process they kind of use to get through that challenge. To me, it's two things. Number one, okay, they did it and they survived. Shows they could do that. Number two, they're probably not going to do that again.
yeah.
So if I can kind of get a CEO who's already kind of made some mistakes, understands the process, and not going to go there again, I've de-risked my investment a little bit to some degree in that respect, right? Um, but really, that's it. I think to understand that really, that again, it's about the business, stock price will come if you run the business, so concentrate on the company. Those are really, I mean, some important things I look at when I'm looking at a team. How do they approach the marketing is really important to me because marketing drives the revenue in the end.
Yeah.
And what does that plan look like? And what is their attitude towards dilution? And those are really important things too. And I'll try and like when I'm interviewing, I'll try and like I don't know, kind of rope them into it, but kind of make them think like I don't mind dilution and see how
Mm,
they come back and answer that. Are they disagreeing with me? They want me to invest in their company, or are they gonna say no? Well, we don't like dilution. Or are they
yeah.
gonna actually come back? And that's important too. Kind of get them in that too.
And so the next question in my mind that comes up there is like, how active are you once you've owned a company? And my guess is you have a pretty consistent dialogue with management, but how active are you? How often are you making suggestions to them about more introductions or talking to them about governance or capital allocation? What is your approach there?
It's pretty fluid, but and so it's obviously a case by case basis. But if I am feeling like the company isn't being run the right way or there's things they can do, I'll definitely, give them a call and be friendly about it and say, hey, let's talk about this. I mean, and sometimes you get pushed back, but then I'm like, you know what? I don't tell you how to run your business, your revenue. I'm not telling you how to run your plan, your
Operation.
business plan. I am telling you though that these things matter in capital markets. So trust me on that.
Yep.
That's usually how it usually works out well. What I'm doing more of now though, Ben, really is getting more involved in, I think we talked about this, is business development opportunities. So now that I've been around the block for a long time, I've talked to a lot of management teams, come across a lot of companies, and there's so many of these companies that are public in the MicroCap space that could be working together.
Yeah.
And I'm really having success with that now, putting these teams together to actually, start, different companies are starting to talk and utilize each other's services actually. So I'm doing more of that.
And I think another common perception within, kind of like larger cap investors is that the quality of management in microcap is relatively low. And you have all kinds of pump and dumpers and borderline fraudulent people. So that those elements do exist. What are your like? How do you suss that out? What kind of characteristics are you looking for? To avoid when you're trying to figure out whether to partner with somebody
You talk when I'm looking at a company, what am I avoiding?
in terms of
Yeah,
management teams.
yeah, yeah. So I mean, I think it's along the same lines there. Like if they are emphatically all about, like you'll come across these teams that are just always asking you about questions about how can I make the stock go up. That's my first, like, stop asking that question.
Yep.
And so I'm not gonna that I'm looking again at that. And what is your how is there this feeling that you want to just sell the company right away? Is that what you're driving for? I want to hear that you're growing the company. And if an exit happens, an exit happens. But when you're driving to just get to sell the company, you might do things in the short term that aren't the best for the long term thing in the company. So I'm looking for teams that still want to look at their company from a long term perspective. If you're not, I'm out. If you don't value, if capital structure principles, I'm out. If you don't understand that how you communicate some of these things in the market, they are important on these things, I'm out. One of the biggest issues that you have right now is a lot of these CEOs listen to investment bankers about how they should allocate, how they should run their business and treat capital markets. And they're the last person they should be asking because they don't care. Investment bankers are short-term partners. And one of the biggest issues you see right now is the advice they're going to get, like a company might get from a that doesn't even need to raise money from a banker. Is, what, you should file it, just have a prospectus out there, or shelf, just in case you need to raise money. It's like the worst thing you could do.
Yeah.
And some of these CEOs don't get it. So I don't want to be part of that. If they don't get it, they're never going to get it. So that's one of my biggest pet peeves right now. You're seeing it a lot. Those teams that don't understand that you should be transparent with your investors, even if it hurts.
Yeah.
So you're starting to see a lot more right now in the MicroCap land is in these press releases, on the earnings press releases. You're starting to see a lot of them kind of use the numbers that look the best. So there's gap versus non-gap thing, right? So you're going to see a lot of companies not necessarily highlight the parts of the quarter that would have hurt their earnings. So you'll say, okay, maybe we lost $1 million, but we had 4 million in charges. Okay, wow, you made money. Well, forgetting to highlight that, no, there was another 4 million in charges that you didn't, or gains you didn't talk about.
Yeah.
And I'm seeing a lot more of that right now. So I think there's a really need right now for some regulation there, like standardizing how these companies should report their earnings.
Totally. I don't want to leave this discussion without asking about the Canadian market because it is an interesting microcap market. I know you said 20% of the index is in Canada. It's my sense that if the US microcap space is ripe for mispricings, it feels like Canadian microcaps that trade on like the TSXV are at another level of potential mispricing. Maybe talk a little bit about how accurate that perception is, where there's even a gap between the valuations that you see in the US versus in Canada.
Yeah, it's crazy. And I'm just loving it now. So Canada was when I got involved in Canada slowly over time. Maybe over the last 6, 7 years, I just dipped my toes in it. And erroneously, I had stereotypes that I would label Canada with, right? It's all mining, all oil and gas. It's, you see these pump and dumps and frauds. And that's how I listened to that narrative. Maybe I should step away for a second and look, beyond that. And you start seeing this beautiful amount of companies that are real companies that are trading at these insanely low valuations. And so I haven't done this, maybe Paul's done it at Small Cap Discoveries. I don't know if he's done it, but there is certainly, just from observation when I go through my research, definitely a valuation disconnect. I mean, you find PEs of 5s and 6s and 7s and 10s on these companies growing their earnings at 30, 40, 50%. That doesn't on a pretty wide base. You don't see that. And they're not value traps. Like in the U.S., that might be a value trap, right? But these are real companies. I think Hammond Power is one of the poster childs now. I used to own that, don't anymore. We found it around, I think, like maybe 10, 11, $12. It was selling at a PE of maybe 9. And today it's almost $100, selling at a PE of, I think, over 20, I believe. And so you had this crazy expansion in the PE multiple. And which is what you hope to see. And I think we want to see more of that. Now, I don't know if it's a situation where I think hopefully as US investors get more exposed to believing there's great companies in Canada, maybe there'll be those re-rates. Maybe that the new, I think, GARP bull market we're going into now may cause a re-rate in multiples in a lot of those companies. But yeah, it's pretty crazy, man, how diverse it can be. And you find a lot of great, like boring industrial companies sitting there in Canada,
Yeah.
which is awesome. These are it's a typical
Totally.
boring big cap, micro cap company. Um, like Hammond was doing, I mean, I don't know what their revenue, for example, on Hammond. Um, let me see what I think. It's definitely, uh, yeah, here it is. It's Hammond Power, yeah. So what did it basically 700 million in revenue is what they're running on here, I think. That's an example, by the way, again, of this big cap, MicroCap. It was a MicroCap company,
Yep.
you know, with almost, getting that $1 billion revenue for them. So selling it as crazy low freaking PE.
And you mentioned Paul Andriola from Canada. What's interesting about the microcap space, which you don't really see in other spaces, that there's these synergistic like kind of content and investing businesses, whether it's Ian and Microcap Club, whether it's you with Geo Investing, it's Paul with small cap, what microcap opportunities. Like it's really interesting to see that. So I'm interested from your perspective, like how does Geo Investing, how does that, what are the synergies for you between that website and the product there? What are the synergies between that and the portfolio?
Yeah, look, yeah, I think that basically, geo investing is, so if you look at geo, it's basically, I would say 90% organic research from our team. These are the kind of stocks I would invest in, or if I am, either I don't always have the capital to invest in all of them. Um, you look at Ian's, all contributor research, right? And then, I'm probably 90% US, 10% Canada. Then you got Paul, who's all Canada, right? Most of that was, I think, organic research. So I think that the three together, by the way, are a great toolkit to have. So to cross reference everything. So I think I tweeted that about that. That should be the case too. So if you are going to be in the space, get exposure to all of it. But yeah, I think the stuff you see in Geo is a lot of the stuff I would invest in personally. In Geo, we have the research that comes in, and we also develop these model portfolios and how we segment the universe into different portfolios. I launched a new product, I think I just told you earlier, the MS MicroCaps, and what that is, then this is a good time, I guess, segue into it, is, so Geo is, videos with CEOs, videos with investors, written content, written reports, morning emails, weekly emails. It's a whole platform of research. And that earnings reviews, like intense. So what MS Microcaps is, and then we have a Substack, by the way, for that now. MS, I think Cliff Notes, is that it's basically all my research. It's my Cliff Notes. So I'm a very big proponent of like writing down quickly why you like an idea. And that's what my Cliff Note product is right now. And so that's the research that fuels Geo. So some of that research that I think is the most timely maybe will feed Geo. So there's 80 Cliff Notes on there, for example, right? Maybe 4 or 5 of those ideas are on Geo right now that we really have highlighted all the time.
Interesting.
So you think of like MS is maybe you're great for an investor who wants a hunting ground of stocks to like look at and get idea generation. Geo is more, it still has that element to it, but it's a more interactive community, and model portfolios and these kind of things. So depending on what you want, but these are all the stocks I'd want to kind of be involved with myself. Like if I had the liquidity all the time, for sure.
Interesting.
Yeah, it's MS Cliff Notes is the Substack. And by the way, the M stands for not my name. The M stands for momentum.
Oh, interesting.
The S stands for sustainability, and the M stands for MicroCaps, MSM. So momentum and price, sustainability in business is kind of what I'm looking at the right time.
And you mentioned that you like to ask management teams about some of their biggest mistakes to understand,
Yeah.
how do they survive and what do they do and, what do they learn from those mistakes? I always like to ask portfolio managers about a mistake that they've made that was so painful that still impacts the way that they invest today. What comes to your mind when I ask that question?
You got an hour? So,
Let's try one.
yeah. So, yeah. I mean, if you want like a case study, um, I guess it would be sell discipline when you know it's time to let go.
Yeah.
And then if you know the whole FOMO. So a great case study would be Wave D, WAVD, which I still might own a little bit of shares of right now, I think. But I used to own a ton of it. And the stock was a great multi-bagger run for me. Uh, we've profiled it on Geo. Originally in 2017, that's how you were watching it. And then in 2020, we went with a longer report on it. It's basically an IT modernization company. They basically go into government agencies and help them rewrite their code to more modern code. There's an old code out there called COBOL, which is all over, like a lot of financial institutions use it and the government uses it. And there's this big push right now to modernize that code to more current code. That's basically the setup. And so in 2020, this is good because it brings in the information arbitrage thing we were talking about, finding information for anybody else. So they were these guys been around for a long time. I don't maybe 50 years or so, sitting in this 7 to 10 million revenue range, right around break even-ish, to make a little money, just floating around. And the catalyst arrived. They won this contract. This is buried in the filing somewhere. You had to find it. That they won I think it was like a 7-year, $20 million contract. So their first time in the history of the company where they have visibility.
Yeah.
And at that time, the stock just did a reverse split of a 1-for-10 reverse split. So I guess at that time it was like 20 cents then, it will be like $20 today. And we bought it, we wrote about it, bought a lot of it. The company was not putting any press releases on about it. They eventually did. So stock goes up to $1.20 from that 20 cent area, right? And our target was like $1.25, $1.30. Okay, we got it there. We got to our target. Now what do we do? And it was basically our target based on the current revenues and what we thought they would be at. So should we wait now to start seeing them execute on this government contract now? Because that move happened within like 5 months. So we're like, okay. And this is during COVID, market's going crazy, right? And everybody's buying everything. They put out an investor presentation about how they think they can be $100 million company in 5 years, and a $10 million EBITDA company, because now they have certainty and all this stuff. And there's all this, they can go get commercial contracts and business. They're very, so then they go raise a little bit of money, but it was all raised by the board, not a lot. Which was great, board participation. They go and buy this small tuck-in acquisition called Tellinger, small company. It gives them commercial exposure now and maybe some more ancillary services. Okay, we're going to wait around a little bit. And they hire a new CEO. And so they calculate $2. They hire a new CEO who comes in like, I think it was in August maybe of 2021, who basically wants to take the company in a different direction.
Oh.
And it was a sexy direction. It was, okay, we want to get more in the more sexier areas, cybersecurity, software. But the company didn't have any software. They were mainly IT guys that would go there and code. So it sounded great. And the stock goes to like 350. He makes an acquisition called Gray Matters, in the blockchain supply chain management kind of solution company. Ends up paying $7 million for it. Okay. And the stock goes up to $5. And they go out there and they make they post for another acquisition. Stock goes to 6. They don't close it. This is all that last acquisition was basically right was announced, or the intent of it, right going into 2022. Now, okay, and I was like, well, I don't know if they're going to raise money. And we knew that they had to raise money to close it, and it was very dilutive. So I'm like, shoot, I already went through my expiration date on the price target. Now I'm like, all right, well, maybe this guy's right. Maybe I know it's overvalued. I know they're overpaying for the acquisition. I know it's a huge multiple, but all right, well, the acquired company is taking stock at $6 a share. Maybe this will be the exception I'll make. So, long story short, they can't get the finance for the acquisition. They found out that the company that was bought, Gray Matters, that the software wasn't quite there yet. Had to write it down, sold it for $2.5 million, hemorrhaging freaking money. It was a round trip. We had kind of unloaded a lot of it and removed it from our model portfolios before the whole round trip. But it still sucked that we knew when you knew it was expensive at $2.
Yeah.
I knew it was expensive at $3. I knew it was at $5. And I got FOMO. I believe that, and I knew that I was looking at price to sales ratios of, 10 to 20 that you saw some other companies trading at right in the space. It's going to get there, right? And as opposed to those guys are too expensive, it's going to come down, right?
Yeah.
And I just love what the hardest part about that, Ben, was that management was investing in the company the whole time.
Yeah.
They were part of the offering. So they were buying the stock, insiders were buying. So it was really tough because you knew valuation, it wasn't quite there, but you were trying to bet in the long term that management was making. And then once it became clear, you're like, oh my, it was 5, now it's 3. I'll wait till it gets back to 5. All these things go in your mind, right?
Sure.
That was probably my biggest mistake over the last 3-4 years. And
I think almost anybody who has a value mentality, and has experienced round trippers like that, and they are certainly painful.
Crazy painful, man. Yeah.
Well, Maj, this has been an incredible overview of MicroCap, both in the U.S. and Canada. Talking about the inefficiencies that persist. I think we've already answered this question to a large degree, but we're going to close with the question we ask all of our manager guests: what is the most underappreciated aspect of the investment opportunity in front of you today?
Oh, I think it's that the world financial media still doesn't appreciate microcaps. They still believe that these are low quality companies that don't belong to, that shouldn't be trading, and that the information disconnects there. If they understood all about the disconnects, they would just be all over it. So that's what it was when I first got involved in it. It's still the same situation today, and it's actually probably even more relevant today. I think the market's actually in the space is more inefficient than it's ever been because of some of the things we talked about. Yeah.
That's a perfect place to close. Maj, appreciate you being on Compounders. It's really great to hear all your stories.
Thanks, man. This is awesome. Thank you.